Major funding for this program is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Murray Hill Properties, Bank of America, SJP Properties, Greenberg TRAURIG. Additional funding for this program is made possible by grants from Arbor Realty Trust, BRT Realty Trust, Burden LLP, CB Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, James D. Kuhn Real Estate Institute at Syracuse University, MASSEY KNAKAL Realty Services, Meridian Capital Group, McSam Hotel Group, Muss Development LLC, Newmark Knight Frank, PALIN Enterprises, Rosenthal & Rosenthal Inc., Signature Bank, Sidney Fettner Associates, Studley, Stonehenge Partners, SWIG Equities, Extreme Contracting and Deconstruction.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State region. Everybody is worried. There's a perceived credit crisis. There's mayhem in the streets. People can't get mortgages. The subprime mortgage. Buildings are falling apart. I don't know. Everybody's saying this. You read the press each and every day. Another headache. Today's Bloomberg says prices are going to drop 15%. But what's really happening? Who's doing this? So I assembled today, for the start of the new season, my 7th season, 3 very knowledgeable lenders who are going to give their opinion of what's really happening today. Are we in a credit crisis? What happened? Why did it happen? And where is this going to change? My guests today include Scott Shea, Chairman of the Board of Signature Bank and a longtime partner of Lou Ranieri of Hyperion Partners, Chuck Rosenzweig, Managing Director of RBS Greenwich Capital Corporation, and last but not least, Brad Wildauer, partner of Apollo Real Estate Finance, and also the man in charge of running their finance company, Arafin. So what's really happening? You know, even though I write, I'm in the real estate business, so, you know, I have I'm like an oxymoron. You know, I know too much, I may know too little. What's really happening? Are we in a credit crunch? Are we in a credit crisis? What's going on today, Scott?
Well, so far, all we've had is the perception of crisis. The real losses, which I expect will be in the range of $200 billion in the subprime mortgage market, haven't actually started to hit. That's going to start coming the end of this year, next year with the alternative A products, and the following year with the hybrids.
So the world is going to get worse? I mean, worse. I mean, the sales dropped in commercial real estate in the month of July and August by 30%. Prices in today's Bloomberg's article said that prices are going to drop 15%. You're saying that we haven't seen the shoe fall off yet?
That's right. I think that this is going to be a slower acting, slowly unfolding change in the real estate market. That's not going to be some sudden panic where the Federal Reserve rides in, cuts rates 50 basis points or whatever, and suddenly the world is glorious again. I think there were excesses in the market that are going to take some time to be cleansed and to improve. On the other hand, I don't think, and I'm not one of those folks who think the world and life as we know it is coming to an end.
We're certainly in a liquidity crisis. I would call it. I mean, what changed over the past 3 months in terms of availability of capital is dramatic. It's very severe. It's as bad as anything in the last 10 years. Some people say worse than 1998 in some respects in terms of the sheer volume of it.
Aren't we also, LIBOR is up to an 8-year high? And we were saying prior to the show about this LIBOR having an effect on the European banks and the German banks. What were you saying?
Well, Michael, yeah, I mean, I think the first thing is you look at the situation today. Liquidity drove values up, and now a sudden loss of liquidity is likely to drive values down. When you talk about the European banks, you're seing LIBOR being driven up. LIBOR is the rate which banks borrow money and it reflects partly their credit. You have a situation now where LIBOR is going up at 5.8, started the year at about 5.25. 2 years ago it was what, 1.1.
Mm-hmm.
And
so, but look at
but today what's happening is you're seeing that there's concerns about the bank's balance sheets. You have a sentiment of people going into short-term instruments, so that's driving down short-term yields in the U.S. Yet you're seeing the short-term rate where banks borrow going up, which suggests that there's concern about the bank's credit. So the credit is going across the market.
Right, but you just brought up a very interesting fact. LIBOR was 1.3, 1.4. We're at 5.8. That's not a 10%. That's a 400% increase over a period of time.
But LIBOR is more in line with historic norms than the artificially low level that had been driven by the.
So who's to
easy
blame?
liquidity.
Who caused this? Who caused all this
all-time
grief?
lows.
Was it the subprime? Was it the mortgage brokers? Was it the countrywide? I mean, I hear a variety of things. What happened? And can people borrow?
Well, this was enabled, basically. There was a sort of a loop between users of credit and folks who were providing credit, and over time, because of a very Goldilocks kind of economic environment, lenders became more and more lax, if you will. Intermediaries were able to rationalize credits that previously couldn't have gotten done and convince buyers to take those. And importantly, and I think your other two guests are even more expert at this than anyone, is because of securitization, no one actually knew for sure what risks they were taking, and they were able to rationalize accepting risks that they thought were so well spread, and yet at the same time, because everybody was taking similar risks, once perceptions and liquidity changed quickly, all of those came home to roost at approximately the same time.
Since you're specifically involved with securitizations, I'd like you to explain to my audience what a securitization is and bring it to focus. Okay, let's take an office building or something like that and explain the securitization concept, and then why what Scott said with the underwriting, with the rating agencies, and let Brad and everybody else fall in. How this.
Well, securitization exists for a lot of asset classes, and the asset
right, but I want to get
residential.
I want to get specifically on a piece
but
of real estate.
They're all connected,
let's talk
which
about,
is why
let's talk about an
where we
office
are.
building in New York City. Okay, somebody bought a building. I won't get to MACLA, which was also in the discussion, but somebody bought a building. 295 Madison is an example that just took place. Okay, Joseph Moynihan bought this building, and as a securitized, he paid, let's say, $300 million. He goes out for a loan. What happens?
Well, what happened, Wall Street intermediates all different types of securitized products. In CMBS, the market really has grown dramatically from the mid-90s through now. I mean, this past year, it was a $210 billion market. And it's a market that I would call in its infancy, in that the new version of it existed in the 70s, but the new version of the CMBS market really came into itself, started again in the mid-90s.
So let's take that building. I want everybody to help me.
Wall Street uses its balance sheet generally, the balance sheet of the lender, takes down a loan on an office building, on an apartment building, a hotel building, retail buildings, and you take all these loans that you make and you pool them together. You get the loans rated by the rating agencies from AAA, the safest part of the capital structure, down to a portion that's unrated. So, there are all sorts of bond classes that are created.
And then we dice and we slice and we...
And then that Wall Street lender goes out and sells bonds against that. But what's happened that made it, further complicated and further sophisticated was that there was also a very mature, a mezzanine market that matured over the last 5 years. Where CDOs were issued with the collateral being
inside
the
baseball. CDO, explain what it means.
Collateralized debt obligations, but generally the CDOs were hedge funds and firms that created high yield firms that bought high yield debt products. So not the safe part of the capital structure, but the mezzanine pieces, the land loans,
right.
the condo conversion loans. And they took those, they pooled those, they got those rated in the same kind of vein as a CMBS deal, and they retained the junior. There's some nuances that are different.
You bring up
that market over 2004 through now grew dramatically and really brought down credit spreads tremendously.
Equity office is sold to Blackstone. the transaction, there's so many transactions and there's so many buildings in the deal. How could the rating agencies say everything is safe? How could they underwrite all this? I mean, how is this done? And then somebody else, then Mackler comes in, they buy something and then Mackler pays $7 billion, basically with $50 million, and how does this happen? I mean, isn't this part of the rippling effect that's having an effect with subprime and everything else?
But I think what happened is this packaging and stratification of risk and selling off of different bonds has made risk that was normal, in previous periods, held by the banks or the real estate specialists, now accessible to broader buyers. And the same thing has happened in other classes. So a triple B CMBS or a triple B residential mortgage or a triple B credit card deal, many buyers are looking at those same products. So the securitization has made the products accessible to non-asset experts. And what's happened is that's brought more money into the sector, and that creates what's also the fast money effect. The fast money comes in, but the fast money can also leave.
So what happens in let me just one point though. In the past, the buyers of CMBS, the bonds, were typically insurance companies, banks, and money managers, mutual funds, and the like. And they held things. They weren't guys that bought it and traded it. Over the past 3 years, what Brad pointed out, it became very much a fast money type of buyer, and the market grew from 75 billion to 100 billion to 173 billion to last year 210 billion over the last 4 years. Now, somebody has to buy all of that. There needs to be a new set of buyers for that. The bulk of the buyers were hedge funds, fast money guys, Wall Street prop trading desks, and they would be they are highly levered buyers.
Is it like the dance? When the music stops, somebody's holding it?
On some level, yeah.
Absolutely.
Yeah.
On some level, but here's the reason why I'm not convinced that lower rates are the panacea. Because what fundamentally drove all of this was, in that low rate environment that Brad was talking about, when Fed funds was at 1, LIBOR was at 1.25, you drove investors to search for asset classes that gave them a little higher yield, because the safe investments didn't. So people who, frankly, didn't know what they were doing investing in a CDO, but were attracted because it actually yielded them something.
Isn't it greed?
Went into
Isn't it greed?
Well,
Rate and greed?
Well, what
I mean,
we're all driven by returns.
Right, it's returns. Okay, greed, fear, returns. It's a question. So what happens today? Okay, something's happened. You're saying that the shoe is going to get worse.
I'm saying it's going to unfold.
But what Brad pointed out is important too, because the same bond buyers that bought subprime and Alt-A mortgages, a lot of these buyers also own CMBS. Now, when that market in February, March started having tremendous turmoil, what do? You sell your most liquid stuff, you short the same types of indexes, so you're shorting a CMBX index. All of that led to a lot of product coming onto the market and a widening of spreads in CMBS.
But what happened this summer is like the summer of discontent. Okay, suddenly February was subprime, and suddenly we did in New York we had $31.4 billion in commercial sales, the highest record ever. 31.4 billion. It exceeded 20 billion last year, and that exceeded 15 billion. And then suddenly July and August, sales are slow, people aren't buying, lenders aren't lending. He's having more opportunities to lend. Signature Bank can lend more. What happened?
Michael, it's much akin to the dot-com bubble. In a lot of ways, both were precipitated by the Federal Reserve and their easy money. And what you're going to see is you had a situation where the liquidity was feeding the market. And it doesn't take a lot of marginal dollars to exit the market to cause asset values and on the securities to drop. And that's what's happening now, is sentiment has changed. Just like sentiment changed when people were saying it wasn't EPS that mattered on stock anymore, it was clicks on .com. And then suddenly everyone woke up and said, what were we thinking?
Right.
And I think there's a similar sort of thing where the liquidity was allowing people to bid up the assets, they were in source of yield, and a little bit of it was somewhat like the tulip bubble that betting on the greater fool theory.
And Wall Street will always create product if there are buyers. And there was a plethora of buyers. They came from all over the world. Right. There was tons of capital.
Now, do we blame okay, let's go down to the residential side. Do we blame the Countrywides of the world? I mean, Scott, Signature Bank was using American Home Mortgage as a servicer for your mortgages. One day, maybe you had some clients over there, they went out of business. American Home, I didn't think was a bad company. I don't think Countrywide, I mean, if I read the New York Times article, it looked like they were a predator, you know, in certain markets. I mean, let me give you a little example. I have a son who's in Chicago. His wife is a physician. She was finishing her residency, and they bought a house. They bought a townhouse, and no income verification. In June, they closed in May or June at 5.25%. No tax return, no income verification. How? How the society allow this? Okay.
You must have signed a guarantee for it.
I didn't guarantee. There was no guarantee. This happened, okay? This crisis happened because certain lenders were out there making loans, okay?
It wasn't just the lenders. It was a collective dissonance. It was everyone's willingness to say, as long... I'm going to go with it because it's
until the music stops.
Right, but you know, people had to first
disbelief.
buy the houses to come to the lenders. Somebody had to decide that this makes sense for me to do because I think values are going up because they have for the last 5 years. And the same thing with commercial. I mean, people were buying buildings because they expected rents are going to continue to go up, cap rates are going to stay low, and this is a solid investment. I can get 90–95% financing.
But people did see things happening, and I mean, I can just speak from my experience a little bit. About a year ago, the subprime crisis to me was pretty clear in the sense that it was, and to many people, to Lou, to others who had been watching this, because rates jumping from teaser rates of 6% to 12%. Alternative A's, where they, these were called no income, no verification loans. Something was going on there. And even with the ARMs, the hybrid ARMs, that you could use rates as low as 1.25 and negative amortize them, they were bound to come home to roost. And so there were people who avoided some of these sectors. And I do think that some of it was foreseeable. What happened is that most of the market chose to suspend disbelief.
Absolutely. Because
there was a certain, I don't know, what was this called? Keynes called it animal spirits.
Yes.
And it's the same phenomena with the dot-com bubble. It's the same phenomena that happened, probably with Texas real estate in the mid-1980s. And there's a lot of collateral damage. American Home, you mentioned. I mean, they went broke in the space of 7 days. I think they had completed an equity offering 3 months earlier with a name brand, I'm not going to mention their name, a well-known underwriter. And in the space of 7 days, they didn't actually go broke based on subprime. They went broke based on liquidity calls and margin calls. And that was the end of them.
So what's going to happen now? Okay, I have viewers here. I have all types of viewers. I have the inside baseball real estate viewers who really want to hear what you're going to say, and then I have the man on the street who watches CUNY TV, who watches on the internet. What's going to happen with the residential mortgage market? Let's talk residential mortgage for the individual.
Where?
New York. We're in the tri-state area, okay? That's the majority of the people who watch my show. What's going to happen? Somebody needs a mortgage. I mean, I noticed today HSBC is quoting a 30-year mortgage at 7.5. A friend of mine got a commitment from them in May to close on September 19th at 5.75. That's a big difference, okay? If somebody's going to have to pay 7.5 and they were going to get 5.75, and you have a budget of what you're going to pay for that apartment, or that house, something has to give. Will the prices go down? Will mortgages be around? What's happening?
There's a couple answers to that question, but the first one is that there's no doubt that real estate prices fundamentally are fed by employment levels, and there could be an impact in New York in the financial services business on employment levels and income levels. And again, we're concentrated in New York on the financial services business. We also have the one sector in New York that has over-plentiful supply is the condo market. So you would expect impact there. There's less supply pressure for houses, for actual physical houses, single-family detached houses. So I would expect less pressure there. But there's no doubt that higher mortgage rates will ultimately pass through to prices. And there's also no doubt, if I could add one more thing, that the 15% of the market that was using subprime or perhaps Alt-A or not having their income verified, those folks have been removed from being able to buy the house that they want to buy. Therefore, there's marginally fewer bidders, and you would also expect that to have an impact on prices.
Scott, and one of the things I would say is, I mean, you know more about the residential business than I do, but it seems to me that folks in the New York area are going to maybe pay the sins for what some of the rest of the country has done, in the sense that the same mortgage lenders who's lending in New York may also be lending in California and Florida, where you're seeing the highest utilization of subprime and Alt-A was in California, Florida, Arizona.
Right.
And that the problems that these lenders have in their portfolios across the country are going to affect their lending standards not only in those markets, but in this market. And you know, I would probably bet, based, you know, just looking at values in New York, most of the people in New York, for instance, you know, the housing values, they don't qualify for Fannie Mae. You know, they're jumbo mortgages. So they've automatically separated yourself from the rest of the country.
I'm doing a show in a couple of weeks on New Jersey, and I had a guy come into my office and we were talking about the Jersey market, and he said, you know, I was building houses in Bergen County, in Union County. I can't build them. I can't sell them. Nobody's buying a house in New Jersey. You live in New Jersey, you know, but new homes are not selling. Okay, new homes are having a difficulty in certain markets in the tri-state region. Go to Asbury Park. Asbury Park, everybody's talking about it. They're not selling over there. You know, there's a glut of new houses being built in condos in Jersey City, in Hoboken. You know, there's, you know, other questions.
Well, sentiment changes quickly in all markets. I mean, I think in the commercial markets right now, we're in a price discovery mode, which could last a while. We're in a price discovery mode. Lenders don't know where or how to price loans because bond prices are moving all the time.
So how do you,
I mean, the buyers. And the buyers don't know where to buy.
And this gets to the commercial, because you addressed the residential. Now we have a commercial. Okay, somebody goes to contract, and people are taking longer. A number of my friends, you know, they said, oh, I was going to close now, I got to close in 30 days, or this and that, or there's what we call in the business retrading.
The 30-day close is gone, isn't it?
Right, and retrading that the price, oh, you quoted me this, and now the price is this? What's happened? Explain this to my audience.
Yeah, what's happened is there's been, since sometime after the first quarter, a dramatic change of where you could sell bonds for CMBS, and it's a large part of the market. It affects bank pricing, too. Even balance sheet lenders syndicate loans, and you know, when there are problems in Germany because German banks bought bonds that they have to remark, they decide they might want more yield to lend on real estate here on balance sheet. So everything is somewhat connected. You can't, you know, just talk about one set of space. But what's happening is all of the financing activity was generally driven by acquisitions, refis with cash outs because rates were lower and values are going like this, so people kept refinancing. And the market grew to a very, very high level. The first quarter of this year was $61 billion of commercial CMBS. And the first half was $150 billion or so. We're going to see an extreme slowdown in the second half and into next year because people aren't transacting. They're trying to figure out where assets are priced.
So people in a way, investors are sitting on the side, sellers are sitting on the side. You know, people, you know, if they have to sell, you know, the question is, you know, should somebody stay with an asset? I mean, next week I'm going to have the investors talk about their opinion of this, and you know, there's a diverse opinion. But I've seen in general, you know, when I can really speak to a true, honest real estate broker, which is like an oxymoron, you know, who's going to tell me the truth of the market is slowed in the tri-state region. Buildings aren't selling that fast. Apartment houses aren't trading that quickly, you know, and lenders are tightening themselves, okay? You make loans. What are you doing today?
Well, it's interesting today because we're in a position where we somewhat, to Scott's point about foreseeability, we felt that something like this was coming, so we kept some of our powder dry. So in the short term, we're buying loans from other lenders who are looking to shed assets on their balance sheet.
So you're a buyer of loans, okay? And you're going to lend money.
We're still writing loans as well, although I would say where we're writing our loans today are at significantly higher yields than where we were writing them.
In a lot of ways, this
ago.
is a good correction, and we sold a lot of inventory. We felt the same thing in the first quarter, that things during the EOP trade, which a lot of people will call a top of the market deal in over the next 10 years, I think, in terms of valuations, in terms of underwriting, how aggressive everything was in terms of lending, on every level. We sold a huge securitization in probably 2 months ago, before things really imploded in CMBS, and slowed down dramatically and widened our pricing to reflect what we think the market conditions are. So
okay.
I think there's going to be good opportunity for opportunistic lenders for buying positions, because, you know, like anything else, these markets, this has happened before. You go through these markets, and these types of events create opportunities for people.
So the banks like Signature and M&T and maybe North Fork, these guys who have their balance sheet lenders, you're in a better shape, right?
Our pipeline is extraordinarily strong for our type of relationship client who's borrowing between $5 and $15 million, not the mega deals, and typically has had the real estate in their family, maybe second generation, in some cases even third generation, isn't looking to borrow 90% loan to value, but wants to borrow what was on the property before. Those folks are turning, they basically can't find conduits that'll finance them anymore, so they're coming to us. And I would say we've had more than our share of folks come to us, and I assume this is the case for the other banks, saying, you know, before it wasn't about relationships, now it's about relationships.
Right, but you know, there was an article, I think, in Crane saying that, you know, somebody was borrowing from Commerce Bank, and it wasn't the first time. It was like he had done a number of deals, and now they said, hey, we're tightening the market. Well, you know, we're going to get higher spreads because we have an opportunity, like you just said. You know, when let's feed a little bit and get a little better rate. We don't have to take 140 over treasuries or something like that. I mean, so that's happening. But my question is, when is this going to clean up? When is this perceived or not perceived, this actual capital markets crisis, okay? I don't want to get to the crisis because that's too dangerous of a word. This capital markets blip or reduction, when is this going to change? How long is it? Is it 6 months? Is it a year?
I think most real estate corrections, be they housing or commercial, generally take not weeks or months to clear up, but generally some years to clear up. And I think there's really no reason to expect this to be all that different.
Chuck?
Well, I don't know what clear up means. I mean, certainly in a very bad state right now, and I think we're going to be in this very bad state. I think it gets probably worse before it gets better. I think we're going to be in this bad state for 6 to 12 months, but then after that, it'll be a completely different environment for a while. I mean, you're not going to get...
You said this was good in certain manners, that this happened because we needed this.
Things had gone, I think, you know, too far in terms of lax underwriting standards, too far in terms of people taking on huge amount of risk for bridge equity on their balance sheets and things of that sort, and valuations, you know, where things didn't cover, were just had gone too far.
Hard to believe, but 30 minutes are up, and we could be talking about this for another 3 hours on now. But I think that for the opening show of the new season, I think I've really given a perspective to the individuals, both the consumer and to the real estate players, what's going on. I'd like to thank Scott Shea, Chuck Rosenzweig, and Brad Wildauer for appearing today. Next week, we're going to get the investors' opinion of what they think that this credit crisis, mayhem, or whatever it is having on the market. See you next week. Thank you.
Major funding for this program is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Murray Hill Properties, Bank of America, SJP Properties, Greenberg TRAURIG. Additional funding for this program is made possible by grants from Arbor Realty Trust, BRT Realty Trust, Burden LLP, CB Richard Ellis, City Habitats, CITI Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, James D. Kuhn Real Estate Institute at Syracuse University, MASSEY KNAKAL Realty Services, Meridian Capital Group, McSam Hotel Group, Muss Development LLC, Newmark Knight Frank, PALIN Enterprises, Rosenthal & Rosenthal Inc., Signature Bank, Sidney Fettner Associates, Studley, Stonehenge Partners, SWIG Equities, Extreme Contracting and Deconstruction.